Hi everyone, and welcome to this week's Symax Fintech Market Insights. As usual, it's split into four parts. First, we look back at last week, then we look forward to this week, then it's followed by my macro outlook, and then obviously the technical analysis I do on a multiple asset classes. Again, we just prepare these, we just try and help you get ready for the week ahead. And hopefully it helps. Okay, so as usual, we start with our disclaimer. So trading involves potential risk of loss of capital. It's not suitable for everyone, but hopefully it is for you. Many companies provide leverage, so just be careful. You can lose substantially more than that initial investment. And of course, everything included in these are just purely for educational purposes. We're not trying to encourage you to trade or invest. That has to be your decision. And of course, before you make that decision, consider the risks involved, your financial situation, definitely your level of experience, and also your risk appetite. Of course, only risk capital you're prepared, but more importantly, you can afford to lose. Any doubts whatsoever, seek independent financial advice before you risk your capital. Okay, so yes, it was another interesting week last week. Stocks again sort of had a good week. Gold was all over the place, WTI, and that was steady as well. So it was an interesting week. And of course, there was some data out as well. So Empire State Manufacturing was better than expected. It came in at 1.1. Although retail sales was lower than expected. It was only 0.2% month on month. And excluding autos, it was actually lower than expected, again at 0.2% month on month. Capacity utilization dropped a little bit, 78.9. Now remember, 80 and above is growth. Below 80 is considered contraction. Although, for me, really, I expect, I would say it's contraction and looking a little bit bleak if it gets to about 74, 75. So 78.9 is not that bad. However, industrial production was again lower than expected. It was negative 0.5% month on month. Housing data again lower than estimates. And then included in that, well, as well as that, I should say, it was initial jobless claims came in lower than expected at 228,000, which just shows that job market is still so resilient in the US. And the Philly Fed, that's manufacturing again, that came in at negative 13.5. So, manufacturing still got a long way to go, but in the US, I would say the economy is still pretty good. Moving on to Europe, and their CPI came out. The core was higher than expected at 0.4% month on month, which again sort of fed into the fact that it was higher year on year as well than expected. It came in at 5.5%. And consumer confidence was a little bit higher, but it's still negative 15.1. And that was really it for Europe. In Germany, PPI came out. That was better than expected, negative 0.3%. That's month on month. And it was, again, a little bit better than expected, 0.1% year on year. And again, it just goes to show that sort of divergence between sort of what producers are paying and what they're charging us as consumers. In the UK, there's quite a bit of data out last week, and again, that sort of fed into expectations for the Bank of England. CPI came in, it was lower than expected at 0.1%. That's month on month, and 7.9% year on year, which sounds great. It was lower than expected, but it's still way too high. And consumer confidence came in -30. PPI, the core output there, was -0.2% month on month, 3% year on year. And the retail sales index was lower than expected at 0.3%, but still 10.7% year on year. So, you know, there's still a lot to go. Retail sales as well came in. That was slightly better than expected at 0.7% month on month. So again, you know, the UK, a bit like the US, is still sort of holding up at the moment. It's still quite resilient. How long that can last for with rates potentially going up at the next meetings, you know, I think this week's data from the UK really sort of put it much more likely it's going to be a 25 basis point hike than a 50 at the next meeting. And then, of course, this coming week, which I'll come up to anyway, but we've got the Fed and we've got ECB. So it's going to be a great week, plus PCE in the US. Anyway, I'll cover that in the next part. Right, so Canada CPI, that came out -0.1% month on month, core 3.2% year on year. So, you know, they're not in a bad place at the moment. And then retail sales was lower than expected, that is, at 0.2% month on month. Royal Bank of Australia released their minutes. Employment was better than expected. Unemployment was lower than expected. It came in at 3.5% again. So, you know, really good there as well. So, you know, all this doom and gloom that's sort of forecast, it's still sort of overshadowing us, but it's not impacting us yet. Even in China, I mean, GDP was better than expected at 0.8% quarter on quarter, but it was lower than expected year on year because it came in at 6.3%. Industrial production was higher though, which was good to see from China. That was better than expected, came in at 4.4%. And then another negative, retail sales were lower than expected at 3.1%, and they left their rates unchanged as expected at 3.55%, so just over 3.5% there. New Zealand CPI was 1.1% month on month, 6% year on year, so again still too high there. And in Japan, CPI was lower than expected at 3.3% year on year. So yeah, so it was an interesting week, and you know that sort of was moving the markets around. Will they, won't they, and how much by, etc., etc. So this is going to probably, this next week is going to be a real tell of what's going to happen over the next month or two, for sure, over the summer months. So right, so that's it for sort of highlights of last week. Let's move on. So before we move on to part two, I just do this in the first and last ones now, although it's there in every single one of our posts. So apart from this, we provide daily newsletters, which include global news, you know, the headlines, then more detailed news across all asset classes, you know, whether it's financial, commodity, and also digital. And then as a subscription service, there's chart levels and pivot points. Then we offer a complete variety of one-day workshops. Again, you know, if you want to look at our academy online, then go to our website. We've just revamped it all. I think you'll agree it's much better than it used to be. And, you know, it's got full details of all of our courses. So all our sort of various one-day workshops, then our one-week courses. One of them includes a free trading challenge. And then we've got our comprehensive accredited masterclass you know, that's really the one that's going to set you up on a trading career. And that can also be taken as a flexi masterclass, and that again does include that free trading challenge. If you're already trading, maybe you're struggling a little bit, maybe you just got 1 or 2 little gaps that you need some help with, then we do trader mentoring, and we can do that by the hour, by the day, or you can register for a monthly subscription as well. Consulting, we help companies with their FX and commodity exposure. And then, of course, we provide a mass of educational content to individuals, exchanges, and brokers. And then, of course, as I've mentioned a couple of times, those funded trading accounts through our partner or one of our partners. We actually can now attach 3 different trading challenges, you know, to get that funded account. 2 of them based on CFDs and 1 on futures. So, you know, that is so comprehensive, and we give you the choice of which one you want to go for. And of course, the important thing is, you know, it's not a case of doing the course and then going straight into the challenge. You've got time to practice, you've got time to hone those skills, and then take that trading challenge when you're ready. If you'd like further details of any of this, contact us at info@symaxfintech.com, or you can reach out to me at chris.tubby@symax-int.com. Hope to see you in part 2.